So a quick recap to get up to speed with where we are. We're doing chapter 24. If you recall, this is a long discussion about the loanable funds market. So within this chapter, we're dealing with primarily the way in which funds get channeled between lenders and borrowers, which happens between various types of intermediaries. Remember that in the loanable funds market, we're dealing with financial capital. Okay? So funds are transferred from borrowers to lenders. And financial capital is different to physical capital. Physical capital are the actual machines, the buildings, the things that we use in the production process. Financial capital refers to the funds which are used to buy those real physical capital. There are three different types of financial markets that the chapter deals with: the loan market, the bond market, and the stock market. But the focus in this chapter is primarily on what is essentially a loan market, the loanable funds market. The stock market we don't deal with in this course. That's something that you deal with in corporate finance, if you take that as a subject. And then the bond market we don't really talk too much about in this course. If you do second year, third year honors, then you talk more about the bond market, but not so much in this course. What are the kind of intermediaries that we use? Banks, any kind of mutual fund that pulls together everyone's risks, like a pension fund or an insurance company. We spoke briefly about the difference between insolvency and illiquidity and the relationship between interest rates and the price of assets. And the price of financial assets is generally inversely related, so the negative relationship inversely related to the interest rate. Price of an asset is inversely related to the interest rate. So when we're talking about the loanable funds market, where does this fit into our circular flow diagram? Compared to the first circular flow diagram that we saw in the introductory chapter, we now have this we now have this additional market here, the financial market. And through the financial market, we have savings on the one side and borrowings on the other side. Okay? So the financial markets are channeling funds from savers to borrowers. There's a difference between the real interest rate and the nominal interest rate. Generally, when we refer to the real interest rate is the return on real assets, like the physical capital, whereas the nominal interest rate is the return on nominal assets, like money or bonds. In other words, nominal assets are financial assets. The difference between real and nominal interest rates is the same as the difference that we've spoken about previously. A nominal interest rate is the real interest rate plus inflation. Or another way of writing that is to say that the real interest rate is approximately the nominal interest rate minus the inflation rate. Okay? So we adjust the nominal interest rate for the inflation rate to get the real interest rate. We then introduced our loanable funds market. There are two different sides to the market, as with all our markets that we deal with. There's a demand for loanable funds, which is downward sloping. There's also a supply curve, but we'll get to that in a moment. So the demand for loanable funds, there's two different kinds of relationship that we're interested in here. This downward sloping relationship means that when we look at the interest rate, okay, we're saying that as the interest rate decreases, so the quantity of loanable funds demanded increases. And what determines our demand for loanable funds at any given interest rate? Well, our demand for loanable funds is a function essentially of our demand for investments. So the amount of investment that we want determines the demand for loanable funds, because loanable funds are what we use to fund investment. In other words, we use the money raised in the loanable funds market to purchase our investment. Okay? So what then determines whether we are willing to invest? well, what's our expected profits from investing in that project? Okay? So any change in interest rates is going to cause a movement along this demand curve. Any change in expected profits is going to cause a movement to the left or right. In other words, a shift in the curve. Okay? We then have the supply of loanable funds curve. The supply of loanable funds curve has an upward sloping relationship. In other words, when the interest rate increases, so the quantity of loanable funds supplied increases. So the relationships that we're interested in here are the real interest rate, disposable income, expected income, wealth, as well as risk generally. A change in the real interest rate is going to cause a movement along our supply curve. A shift in any one of these other factors is going to cause a movement in the entire curve. In other words, a shift in the curve left or right. When we bring supply and demand together, we're going to have some equilibrium interest rate and some equilibrium quantity of real loanable funds. Is everyone happy with what we've discussed so far? Any questions on that stuff currently? Okay. Everyone happy with the upwards sloping, downward sloping, and what causes a shift? Everyone with me on that? Okay. Then changes to demand and supply, we've already discussed those. Anything that changes on the supply side, any of these factors here, on the demand side, changes in expected profit. Okay? This chapter then goes on to talk about the effects of government in the loanable funds market. And here the chapter is quite scarce on detail and is not particularly, I'd say, well-founded in its discussion. And for that reason, when it comes to testing this material, we're not going to focus on what happens when you have a government surplus or a government deficit in terms of which of these curves shift. Okay? And why I say that it's not particularly well-founded is because the way the textbook discusses a government surplus, so when the government has a budget surplus, the textbook describes a shift in the supply curve. Okay? However, when the government has a deficit, it shifts the demand curve. And it never really makes clear why it shifts the demand curve in one instance and the supply curve in another instance, right? The reasoning behind what they're discussing is obviously when we're talking about supply of loanable funds, this is funds that people are willing to lend. The idea of a surplus being on the supply side is because the government budget, the budget that, in other words, the spending, the budget is made up of revenues, right? So revenues are positive to the government, and taxes, what am I talking about? Revenues which are taxes, okay? So the budget's made up of revenue. What kind of revenue does the government generate? Taxes. And then there's government expenditure, which we call G, which is then negative, okay? So government spending. The budget is positively influenced by taxes and negatively influenced by government spending. In other words, our overall budget will be positive if taxes are greater than government spending. You happy with that idea? The budget will be negative if government spending is greater than taxes. Okay? If the budget is positive, we refer to that as a surplus. So, if the budget is negative, we refer to that as a deficit. Okay? So this chapter is basically taking the stance that if the budget is in surplus, in other words, taxes are greater than government spending, the government has extra money lying around, it can therefore lend that money in the loanable funds market, and the surplus constitutes part of the supply of loanable funds. On the other hand, if it's got a deficit, in other words, its spending is greater than its taxes, then it needs to somehow get hold of money, right, in order to spend more than it's actually getting in taxes. The way that it gets that money is by going into the loanable funds market and demanding loanable funds. Okay? So the idea that a deficit shifts the demand curve makes sense. The idea that the surplus shifts the supply curve makes sense. However, you can also think of a government deficit. If a surplus shifts the supply curve to the right, that's a surplus. You can also think of the government deficit shifting the supply curve to the left. Okay? In the same way that a budget deficit shifts the demand curve to the right, that would be a deficit. You can also see how a budget surplus would shift the demand curve to the left, right? So how does the textbook make a distinction between why a demand curve is shifting and why a supply curve is shifting, right? It doesn't. Of course, if we're talking about what happens in practice, whether the supply curve shifts or whether the demand curve shifts all depends on how the government is actually funding its surplus or how it's funding its deficit. Is the Reserve Bank, for example, going into the bond market and doing open market operations at the same time that the government is changing its fiscal policy? So in reality, both the demand curve and the supply curve can shift. The textbook does not talk about that. What is important, I think, from the discussion that comes from this textbook, is that when you have a government surplus, right? In other words, either the supply curve, right, is going to shift to the right with a surplus, or the demand curve is going to shift to the left with a surplus. Okay, either one of those surpluses. If we've got a surplus, what is important? The interest rate will go down. Okay? That's what's going to happen with the surplus. If we have a deficit, what's going to happen? The interest rate's going to go up. Okay? That's what's important. Whether the demand curve shifts or the supply curve shifts matters only for the quantity here. Okay? That's where demand or supply curve shift makes a difference. And I'm saying, don't worry too much about that. We're not going to ask you in terms of a diagram whether the demand or the supply curve is going to be shifting. What we are interested in is this decrease in the interest rate when we have a surplus, or an increase in the interest rate when we have a deficit. And in fact, this relationship, this deficit and this increase in interest rate is more general than just having a deficit. This positive interest rates, we can describe more generally as an increase in government spending increases the interest rate. Or alternatively, if we have a decrease in taxes, same thing. Okay? In other words, there's two ways that the government could end up with a deficit. Either it increases its spending, or it keeps its spending constant and it decreases the taxes. Okay? Both of those will shift the government towards a deficit. But whether the government's in a deficit or not is largely irrelevant. If we increase government spending, you will have an increase in interest rates. Okay? When you have a budget deficit, you're going to have an increase in interest rates. Why? Because the budget deficit comes from one of these two things here: an increase in government spending or a decrease in taxes. The reverse then for this surplus discussion is obviously if we have a decrease in government spending, what can we expect? Okay. That's the kind of takeaway from this chapter as we move forward into the other chapters. Any questions? You happy? Cool. Yeah.
How does increasing interest rates decrease the budget deficit?
No, increasing interest rates doesn't change the deficit. The deficit changes the interest rate. Okay? So the interest rate doesn't change the deficit, it's the deficit that changes the interest rate in this discussion. Right? In other words, the change in fiscal policy here causes a change in interest rates. You happy with that idea? You see which way the causality is going? Okay, when we change government spending or we change taxes, this is called fiscal policy. Okay? How the government chooses to raise revenue, how it chooses to spend the revenue that it raises, those are fiscal policy decisions. So then the textbook goes on to describe, first of all, the crowding out effect. And the crowding out effect is an important effect, and we will discuss it more outside of the context of the loanable funds market, but it does get introduced in the loanable funds market. Here it says, the tendency for a government deficit to raise real interest rates, which therefore decreases investment. Okay? As we saw, it's not linked only to a deficit. Crowding out, when we increase government spending, that leads to an increase in interest rates. That increase in interest rates is going to do what to investment? Decreases investment. Okay? That's the crowding out effect. When in this chapter, we're talking about it in relation to a deficit, but it's even broader than just a deficit. Okay? They then describe something called the Ricardo-Barrow effect. This is not something, again, that we need to concern ourselves about in terms of the diagrams, as long as you know it as a kind of a rote learning thing. It basically just says, well, hang on a minute. When the government makes some decision about its budget, okay, whether that budget is a surplus or whether it's a deficit, something is going to happen in the loanable funds market. There's going to be a shift in demand or supply of loanable funds. And if people are rational and they understand that the government is going to take this action, they themselves take action in response to the government's action. And what we end up with is no effect on interest rates. Okay? So that's the theory about how people respond. So this is just how, I say people, whatever, agents in the economy, so how agents respond to fiscal policy. Okay? But we are not going to, at any point in this course, assume that the Ricardo-Barrow effect is in place. Okay? So the Ricardo-Barrow effect says there will be no effect on interest rates. Okay. That's interesting theory, but that's not going to be how we take things forward. Okay? The Ricardo-Barrow effect, in other words, says that this won't happen. Okay? Ricardo-Barrow effect says that won't happen. Okay, that's nice, but it will happen for the rest of this course. Okay? So then there's a discussion as we continue in this chapter about what is the effect of the international market on the loanable funds market. and this is, apart from being a little bit difficult to discuss without knowing more about imports or exports or exchange rates, the real takeaway thing here is the fact that if we just look at our normal learnable funds diagram, when we have international markets, then our supply of learnable funds is not only savings from our own households, but also savings from anywhere else in the world can come to our economy, right? The demand for loanable funds in our economy, in other words, anyone that wants to borrow money in our economy, is not limited to only the people within our economy, right? In other words, people from anywhere else in the world can also come into our financial markets and borrow funds from us. Okay? So, supply and demand of loanable funds, although in our diagram here we were kind of assuming that we were just talking about our local economy, it can be expanded to a global economy. And now things get a little bit complicated. Because what happens is, if we think about the entire world economy, and we have the supply of loanable funds in the entire world, and we have the demand for loanable funds across the entire world, there will be some equilibrium interest rates that equates supply and demand for loanable funds. Okay? But in any particular market, what might we have? Well, in our own local market, the supply of loanable funds, which is just by locals, okay, so this is locals, and the demand for loanable funds, just by locals, okay, might give us some equilibrium interest rates, say 6%, okay? If, however, the global interest rate is 5%. In other words, I could go out into global financial markets and borrow funds at 5%, right? If I can borrow funds at 5%, why would I be interested in borrowing funds locally at 6%? Would I have any interest in that? No. So then what happens is essentially our interest rate is exogenously fixed at 5%. Okay? Here is what locals are prepared to supply at 5%. Here is what locals demand at 5%. And what is the difference between these two? The difference between the two is obviously a shortage in the supply of loanable funds locally. Right? Everyone with me on that? The supply of loanable funds is less than the demand. There's a shortage in the supply of funds. You happy with that? In other words, there's excess demand. Yeah? So where does the money then come from that people borrow? If our locals are only supplying some quantity corresponding to about 1.5, but the locals wish to demand or wish to borrow a quantity of 2.5, the difference between these two quantities comes from foreign lenders. Does that make sense? In other words, the quantity that will be demanded at 5% is 2.5 billion in this example. 2.5 billion rand is borrowed. Of that 2.5 billion rand that's borrowed, 1.5 billion rand is from savings that come from within the economy, and the difference between the two, the 1 billion in between, comes from foreign investors lending money to our local investors. Does that make sense? You guys with me? Okay. So what I had said right at the beginning of this chapter was that when we deal with the loanable funds market, although we discuss an upward sloping supply of loanable funds and a downward sloping demand for loanable funds, really when we look at the loanable funds market, when we discuss it in the rest of the course, there's two different ways in which we actually think about it. The one way is with either a vertical supply of loanable funds or with a horizontal supply of loanable funds. Okay? The reason you might have a horizontal supply of loanable funds is from the discussion that we're having here, right? In other words, the interest rate is set exogenously to the local market. Okay? So we're not really that interested in what the supply of loanable funds is doing, because what determines the quantity of loanable funds? The demand side, right? And any difference between the quantity demanded at the exogenously given interest rate and the quantity supplied locally, any difference will come from some exogenous factor like external borrowings from other countries. Okay? So the curve that we're really interested in is the demand for loanable funds, which becomes our investment curve. Okay. So that brings us to the end of the discussion in that chapter.